Hi, everyone. Welcome to YX Insights. Today is April 11th. We are just after market open in the New York morning. Today, we're going to go through the CPI from yesterday, as well as the macro environment we are in today. I'm also going to elaborate a little bit about our quantitative model for TLT, and we're going to apply the similar modeling for Bitcoin Max 7s. And we're also going to look at the price technicals, the live charts for the tickers we cover. So let's begin. Every day I send this YX Insights dashboard. I designed it this week, and I think it provides a comprehensive picture from the top level of macro environment we're in, to the rates move that's driving the various risk assets behavior, to the last night's close of the rates, oil, gold, Bitcoin, and the stock market. And we can look at how the market really reacts to the macro drivers, as well as exogenous shocks like Trump announcing tariffs and then pulling tariffs and then putting them back on again. So a few things. So yesterday CPI came in lower than expected. We're going to go through that in a second. So I think it could start a deflationary trend from here. So this is not stagflation, but deflation. And secondly, the Fed on futures now see forecasts in 2025. So the market is pricing in double the amount of cuts that the FOMC projected just in March. So the March FOMC pinned down 2 cuts, and the market sees 4 cuts right now. At the same time, the Fed liquidity and the global M2 money supply continue to expand. So the Fed has essentially scaled back all of its QT for the treasuries, except for 5 billion, and then it's kept the same amount for the mortgage-backed securities. But the treasury is still drawing down cash, which is beneficial to the liquidity environment. And at the same time, because of a weaker dollar, we are seeing an expanding money supply from the G5 countries, which is US, UK, China, EU, and Japan. So those liquidity factors should provide a tailwind for risk assets to perform to the upside, all else equal. But obviously, right now we're in a huge macro uncertainty because of the administration's policy. So those tailwinds may not seem obvious. They're more like the wind. I like the analogy of the wind. The birds can fly with the wind or against the wind. But when the bird is flying in the same direction of the wind, it's much easier. So when the stock is ready to bounce, ready to move up, as the investor risk appetite expand, we'll see much sharper rebound versus if the liquidity conditions were contracting instead. And finally, bonds and stocks both got hammered yesterday. So yields up, stocks down. This is opposite of what we saw before, where yields and stocks were traveling in the same direction. People were buying bonds and selling stocks. Instead, gold is up significantly. So that shows that investors really treating gold as the safe haven rather than bonds, but also it supports the theory, which is not really a proven theory, that China is dumping its UST holdings to hurt the US Treasury issuance this week. And they're buying gold instead. So China, as of January, held about 700 billion, just behind Japan, who hold about 1.1 trillion. So it's a sizable firepower, because if China is not buying or China is selling, Japan is not really buying, because Japan is a net seller over the past few years. The BRICS countries are not buying. Then it's really the private households, US banks, and European funds that are buying, and they're much more price sensitive. So they're a bit more momentum driven. So I think what this means is that if yields continue to spike from here, the Fed will have to U-turn its QT policy and start QE some point this year. And originally, I was thinking maybe in Q4, but actually, it could be as soon as this summer. So it's a speculative view at the moment. So we'll just have to see what happens in the upcoming FOMCs and what Powell's tonality is like around this topic. One thing I did point out in yesterday's newsletter is that SPY was up 10.5% 2 days ago as Trump paused on the tariffs. Last time SPY was up more than 10% was actually in 2008, the great financial crisis. We had a sharp bounce of 11.7%, and then the market tried to move higher, but ultimately made a new low a month later. So this large bounce was in October. The market didn't really bottom until March 2009. So it's quite, to me, it does feel more of a bear rally, which means the investors are likely to sell the pops or sell the rally just to get out at a better loss, etc. And the underlying risk capital is still quite weak right now. CPI came in below the expectation in the headline call. So I used the quantitative modeling for this. And my expectation was that core CPI was going to be weaker than expected, and headline CPI is going to be higher than expected. And I think the reason is essentially the hourly earnings really cooled in March from the non-farm payrolls. So it wasn't going to be as hot as before, but oil prices did rebound in March as well. So that typically should drive CPI higher, but we obviously, for this month, there was a bit of a decoupling, possibly a lag in the impact of the oil price rebound versus how price changed on the ground. So let's just look at the actual trends. We're seeing headline CPI 2.4. That is year on year. So that is the same as September 2024. But actually, this is a very sharp fall from 3% just 2 months ago. And also, the core CPI has broken down from its sticky level of 3.1, 3.2 and 3.3. So it went from 3.3 in Jan to 3.1 in February, and now 2.8. So this, both the headline and core are pointing down. So again, I want to emphasize that we are unlikely in a stagflation environment. So stagflation means there's high inflation, but economic growth is stagnating, hence the term. And people liken the current environment to the oil prices in the 1970s. The big caveat is that tariffs are man-made in the sense that it's policy-driven. So the White House has placed a bunch of tariff policies which could drive inflation up in a one-up fashion. So let's say 100% pass-through, raise tariff by 20%, and you get inflation up. But the White House can also remove these tariffs, as we saw 2 days ago, and then the price will come down again. So then you would have a one-off price decline as well. So it's not quite like the oil price shock, where the shock is on the supply side and it's more persistent, and it takes time to address the underlying issues in the supply chain or the energy supply. Here, the White House can add or subtract tariffs very quickly. So just pushing ahead to look at the key components. So the biggest driver of the headline CPI was energy, which fell by 2% month on month. So this is not an annual figure, it's 2% fall, which is pretty big. And it does seem to be more of a lag effect from February and January, because oil essentially topped in mid-Jan. and it had been declining throughout January and February. That seemed to have fed through to March. So there seems to be a little bit of a lag. Also, commodity prices fell. So used contracts fell by 0.7%, and Medicare commodities fell. So these are very small components of the CPI. But still, it shows a trend of goods essentially being in a deflationary mode. And we're seeing transport services, even motor vehicle insurance levels declining month on month. And that's a first, because motor vehicle insurance has been a very persistently hot sector area, due to the lagged impact of more cars on the road from COVID and supply chain impact. But actually, for the first time in a while, we've seen the insurance coming down now. Airline fares continue to go down because consumer sentiment is poor. People are not really wanting to spend money on traveling or trips, etc., due to the economic uncertainty. So that is kind of expected. What we do have is that owner's equivalent rent of residence, which is the shelter cost, has gone up slightly. That contributed to 0.1% on a month-on-month figure, but it was not enough to offset the energy decline. Having said that, I would also be really careful that this owner's equivalent rent is essentially a survey asking the household owners how much they would rent out the flats for or houses for, had they not been living in it. And we can see that this figure essentially is a heavy component of CPI, but also fictitious. So it's very notoriously difficult to predict. And if you actually just put this on a flat figure from just as the rent is to 0.3 month-on-month increase, we are actually probably seeing all CPI also in a deflationary trend. So I would just say that overall, we're actually seeing the beginning of deflation rather than stagflation or persistent inflation. The market now sees 4 cuts in 2025. We are expecting a cut either in May or June. The market thinks probably in June because the Fed just wants to wait and see. Obviously, the worry is that the Fed is acting too late, as always. Pretty firm to have 2 more cuts in July and September, and then 1 more before the end of the year. So that's 4 for 2025, and possibly 1 more in 2026. So the market hasn't really put that much weighting on cuts for 2026. You could argue that its forecast is still actually quite low in terms of expectation. We should be maybe pricing more aggressively for 2026, which is not reflected yet. As you can see in this curve, market sees a sharp 100 basis point decline into 2026 and pretty much leveling off over here before expecting more rate increases beyond 2027. The curve steepens over here. My expectation is that if we are in a territory where the Fed is willing to cut 4 times in 2025, that probably means we're in a beginning of a recession, and I think 2026 should be probably much lower than where we are now, possibly below 3% or 2.5%. So the market is really projecting a small chance of a recession still, or maybe 50-50 chance of recession, but definitely not like 100%. And also still thinking that the yield curve steepens beyond 2027. So for me, I think it's almost like we should be either saying there's no recession, we should have cut twice, or if we have a recession, we should be cutting 8 times in the next 24 months. So I think as an investor, you can kind of weigh which way you lean towards and bet accordingly. Liquidity conditions for Fed liquidity is still pretty benign. So the red line is the Fed liquidity on the 5-day average to smooth out the daily swings. Really what we see is that it's just been upwards since January, and that has supported bond prices and therefore yields lower. We saw a small spike in yields in the past month, as we've discussed in our newsletter, but still overall, the levels we're seeing now is not as aggressive as it were before the inauguration. So the question is really, have we bottomed because rates are going higher regardless of the financial conditions, or actually it's now a really good buying opportunity for bonds? And we'll think about this in a second on the live technical charts. More Fed cuts have been priced in. Why is TLT falling? And the answer is basically curve steepening. Curve steepening means the far end yields are moving higher versus the front end yields. So we're seeing that the front end is pricing in more cuts from the market pessimism about economic environment and tariffs, but the 10-year yield is actually, and the 20-year, 30-year yields are all moving higher relatively to the 2-year. The big question I've raised is, are we seeing a topping pattern here in the 2-10s yield curve? Or is this actually just going to go all the way up to 120 basis points? So we're at around 60 basis points right now. And from a technical perspective, this is wave A, this is wave B, and this is wave C. So wave C is typically 100 to 120% extension of wave A. So theoretically, it could stop at top here and start reversing down, and that's it. We're going back towards parity again. But if it goes beyond this box, then we're more likely in a impulsive 5-wave up territory, which means the longer end yield will go much higher than where we are pricing today versus a 2-year. And even if we get retraced, it will only be a wave 4, and then ultimately wave 5 is 120 basis points. We are at the crossroads here. I'm leaning towards this being a topping pattern, but to be honest, I think it's 50-50. So it's more of a coin toss. We just have to watch how far it stretches. If it turns down here, then we can probably feel a bit safer that this is an ABC correction or heading back down versus 5 waves up. My model prediction for next 5 days from today is mildly bearish, and I'll explain what this means. So the model throws out a score, essentially, which I rank as strongly bullish, mildly bearish, and strongly bearish. And if you bought TLT on the days where it is the signal comes as mildly or strongly bullish and held cash, i.e. sold TLT and held on to cash on the days where it is mildly bearish and mildly or strongly bearish, you would have outperformed the buy and hold strategy in the 1,000 day over 1,000 days in our trading sample. So the strategy returns about 80% versus the buy and hold returning essentially negatively in the sample period. And overall, our hit rate has a 5% edge to buy and hold. So if you are buying and holding TLT on any random 5 days, you will do worse. Your chance of being correct, as in making money on those 5 days, is 5% lower than my model strategy. It doesn't sound like a lot. It doesn't sound like 100%, 70%, whatever, but actually it is a significant edge that compounds over time. Because if you think about what casino does, if you're playing roulette or blackjack, the casino probably only has 2% to 5% edge anyway, but because the casino plays huge volumes, the consistency actually outweighs any random day's luck. So this is a signal that I'm going to be tracking every day, and I also will produce the results and the charts to say, okay, given the past month, how has the signal done versus reality? And we can always try to decipher on why the signal is wrong if it was overly bullish, because at the end of the day, the model is just trying to pattern recognize from what the market has shown to be very correlated returns in the past X number of days. And if that relationship breaks down on day 1 or day 2, the model is probably not going to recognize that straight away and think it's a buying opportunity. So we can recognize where the gaps are as well. So it's very useful reference points, regardless of whether you're trading according to the model. If I just bring in the 30-year chart, what really bugs me is that we made a higher high here on Wednesday that broke the high of here. For January. So technically, this cannot be a 1-2 down, right? The best case scenario is some sort of A, B, C, where the B starts over above the top. And it's kind of like an expanded flat. But I'm very, very worried that actually this is a 1-2 setup over here at the end. And then we're heading towards wave 3, which is 5.86%. And this is not the position I thought we would be in at the beginning of the week. So this has been a very dramatic week for this. Because it's traveled towards here, that does typically signal there's more leg to go on the upside, even though this was just intraday spike. Typically, when those spikes happen, there's a lot of people who think maybe this makes sense and will buy on the retrace. As we can see, it fell on Thursday and it moved up again today. So now coming back to TLT, if we follow the 30-year chart, 30-year yield chart, which is the closest region to the TLT duration, we then are looking at wave 3 being -1 here on the downside. And essentially, that's pointing towards mid-70s. Again, this is not my expectation at the beginning of the month or even last month. But technically speaking, we have to respect what the chart is showing. The best case scenario for now for the bullish parties is that we have an A, B, C correction. And this is actually just a B wave here. And this is a wave C up next. But I think that for me is an alternative path right now if this 84 price of January low can hold. So on the 30-year chart, this is already broken, but TLT has not broken this technically on here. I very much doubt that the 30-year chart and TLT will diverge because obviously the TLT holds the 20-year and 30-year bonds. So next up, Bitcoin. I think the Bitcoin chart is very simple to read now because it just has a couple of jobs to do for us to know which way it's going. And before I get into the chart, I would just say next week onwards, we're going to launch the quant models for Bitcoin as well. So we'll get a daily signal for Bitcoin. And one of the things I've been thinking is that maybe I'm going to send separate newsletters once we're now in the beta testing stage, but once we're all ready, I'm probably going to send a separate daily update for the signals because it takes me time to write up, etc. But the signals are much quicker to produce, and therefore I don't want to wait for the market to open to finish writing and then send it out and everything, and people miss the trade. I think it's probably easier if I send the signals first, probably in the morning during London time, and then I will send out a write-up, which will just be on technical analysis or the fundamentals or the valuations, etc. Later in the day. So let me know in the comments or on Slack what you think about this idea. So right now, for the price technicals, BTC really has to just move above this resistance here. We have a trend line support over here. And the reason I've highlighted this box is that wave 5 typically is 138 to 160% extension of wave 4, the inverse extension of wave 3 to wave 4. But we didn't really touch that. We only got to 123%. It's not a necessary condition that it has to touch this, but it could happen. So I'm just going to flag this possibility here. And because the way this chart has trended, it has become quite clear now in hindsight that it's 5 waves down. And therefore, the next this is the primary trend. The downward trend is the primary trend, and the next bounce is likely a B wave bounce. And if you just look at the volume that's trading here, that kind of makes sense because there's a lot of buyers at this 100K level or just below 100K level who are basically trapped right now. They're underwater. And once Bitcoin gets above the 200-day and into this region, they probably want to offload and just ease the pain of backholding for over the past 5 months or so. So I do think this is a heavy supply zone. If we can break above this in a 5-wave fashion, then yeah, up we go to wave 5. But my primary expectation now is probably a 3-wave pattern into wave B high here, just under 100K. So it's up to the individual investor what they want to do. Once it reaches here, wants to hold on and kind of like wait for it to turn up or have a trading stop loss, just in case it is heading towards wave 5, or they can offload and try to get a lower entry back here. I'm just going to say that a lot of this is really hard to see how the real life how the pattern emerges in real time. For example, here I really did think where we were in the ABC correction here, and we would have ended wave 4 here. But it's only in hindsight, with more development, with lower lows breaking over this point, we can really tell, okay, actually these are 5 waves. And actually with algos or with chart reading, there's a lot of estimates, subjectivity estimates and guesswork, thinking which one is more probable as the chart develops. Once you are having high confidence where things are, it's probably because you got more evidence from the chart that's already happened. So now I think the point I'm trying to make is that if you bought here thinking this is a C wave, and obviously the things have not turned up as you would have wished, it's a trade-off. It's a risky trade-off in the first place, not having the full 5 waves up as a signal that we have bottomed, versus if you're just waiting for this bottom pattern to accomplish, getting more signals, and then kind of having a clear picture of what happens next. But then you could have obviously easily missed out if Bitcoin did break out from here. So again, everything is certainty versus reward. And you just have to decide what you want from whatever tools you're using. There's no tool that is a crystal ball that tells you 100% what happens. So Apple, to me, I would want to just explain my rationale here. It looks like an ABC here, and this wave C is this capitulation leg is the C leg, and that's reached 100% extension of wave A. For me, I think this is sufficient to complete. And if for prudent investors, what we really want to see is this wave 1, wave 2, and then 5 waves up from here. So for example, so that would bring us the first 5 waves up. And then what we want to do is an ABC correction from here, and buy at this pullback. So while I think this is the bottom, I'm much leaning towards seeing 5 waves up and then buying at the retrace. Obviously, the risk is that you miss this wave here, this 5 waves here, but again, it's a risk reward issue. Amazon as well, it didn't quite reach the 100% extension wave A, but it's walking a fine line because this is the only wave B I could see from this chart. But if it doesn't reach beyond 100% extension, then it invalidates my wave 2s here. So I couldn't quite yet piece together where things are. If it invalidates now, I really have to reassess where this wave 1 sits, whether we are in the new wave 3 But as it stands, I still favor Amazon to dip into 150 region, and then from there we're turning up to 300. And the 300 essentially, if we're just looking at wave one versus wave two, assuming wave two stays around 150, wave three is basically 138 extension of wave one from the wave two low once it finishes. Google is a quite tricky one to decipher because to me, this is a wave B. That's the most obvious wave B we have. And therefore, if this is wave B, we didn't really quite get that wave C that we want. In fact, if this wave C terminates here, it's quite a short wave C. And therefore, I still see the downside. There's the alternative where we have 1, 2, 3, 4, and 5 waves down. And that would be the end of wave A already. And the next one is a wave B bounce. It sounds very similar to Bitcoin, essentially. We would expect a 3 wave up for Bitcoin, for Google, and then a further wave C down. And for Meta, I think it just touched the 100% extension, which basically means wave C suffices in length, and that could begin the 5 waves up against this wave 5 high. However, like for Apple, I will just try to be a little bit cautious and wait for 5 waves up first. Which will be pointing towards 700 direction once if we get it. And this is just very preliminary work, assuming wave 2 comes down a bit lower. And then we can buy on our retrace here, ABC retrace once 5 waves up are finished. Obviously, there's an argument to say, well, why not just buy now and aim for this wave 3 anyway? And even if it's just wave C correction, you still get that. And I think that's perfectly valid, as long as you really control your downside on the stop loss just below the 279 level. 479 level. Microsoft, I think the biggest takeaway is that we had a very prolonged wave 4 correction over here from June onwards. And I think there was a lot of head fakes. It really looked like we're going to have 1-2 set up here, but ultimately this was proven to be a wave C. But it does look pretty done now. In terms of this wave 5, it's pretty stretched compared to the length of wave 4 from wave 3. So to me, we should be bottoming here and aiming for wave 5. And wave 5 right now I've marked as the 138 extension of inverse extension of wave 4. So again, it's just very much like Google. We are waiting for the 5 waves up from here. But you could argue this is the lower risk reward because of how, the chart pattern here, that there's probably a higher confidence that we've bottomed. So really, it depends on your risk appetite, whether you want to wait for the whole 5 waves up and buy on the dip, next dip, or you are gonna try your luck here, but with a stop loss at 345. With SPY on the whole index level, I think we still see some weakness. It did feel like a bear market rally, so I would probably be a bit more patient. And thinking about the Max 7s kind of corrected before SPY did. So maybe the Max 7s won't have that much more room on the downside. But at the same time, if the indices are still weak, the Max 7's probably going to spend quite a long time zigzagging in the bottoming formation as well. So it's just a matter of weighing the risk versus reward in here. And I think for NVIDIA, it's very, very similar to Microsoft. We spent ages in this wave 4. We even had an expanded flat where wave B really looked like wave 3 here. And actually, it's an expanded flat, meaning wave B starts higher, tops higher than where this wave 4 starts, which is this point, but wave C is lower than where wave A is. But for me, I do think it's probably heading, like Microsoft, is probably heading towards wave 5 now, finally. However, I would again urge caution or patience to say at least we have a few trended line resistant overheads to clear. So really, we want to see something like this pattern going forward, or even maybe more directly stretching to here like this. So that's it for today. Thank you. I spoke a bit quickly today in the interest of getting this video as compact as possible. Any questions, please ask me on Slack. I update all the charts daily now, so it should be, there's a lot of focus and also room to adjust our errors in the analysis when they arise. Thank you very much.